Welcome to the Deep Dive. This is the place where we try to cut through all that daily market frenzy, the speculation, and really focus on something much more lasting, fundamental value.
Exactly. If you've ever felt just overwhelmed by the constant stream of financial news trying to guess the next hot stock, well, this deep dive is hopefully going to be a necessary reset for you.
Our mission today is pretty straightforward, but really crucial. We want to distill the essential, actionable wisdom from Pat Dorsey's well-known work, The 5 Rules for Successful Stock Investing.
Yeah, and this isn't just abstract theory. It's a really comprehensive, proven framework. It's built directly on the shoulders of giants, value investing masters like Graham and Buffett.
And it's designed to help you build wealth, slowly, patiently, and importantly, thoroughly.
Dorsey really hammers home one core idea right at the start, and it's vital we get this. It's the business that matters. That's the key.
Right. The market, especially day-to-day or month-to-month, it can be totally manic, capricious. Dorsey even compares it to a casino.
He does. You can see fantastic businesses selling at ridiculous fire sale prices sometimes, and then other times, really risky money-losing companies trade at these just dizzying valuations. It doesn't make sense short term.
But, and this is the critical part, over the long haul, say 10, 20 years, those wild price swings tend to fade into the background. The stock price, eventually, it tracks the actual success of the underlying company.
Yeah, think back to Walmart. In the mid-1990s, their growth rate slowed down just a bit. Still a huge, profitable company, obviously.
Obviously.
But the stock price basically went nowhere for about 5 years. Just flatlined.
Why? Because the market had already priced in way too much growth, right?
Right.
Expectations were too high.
Exactly. The expectations got ahead of reality. Now, contrast that with what happens when the fundamentals really take off.
Okay.
Look at Colgate-Palmolive in the late 90s. They went through this major overhaul. Supply chain efficiencies, cutting costs, launching innovative products.
They really turned things around internally.
They did. And their profits soared. And guess what? The stock followed. Dramatic gains, precisely because the underlying business got fundamentally better.
So that's what we're here for, to give you the 5 rules that help you spot those long-term Colgate-style winners. And just as importantly, avoid the big mistakes that derail most investors.
Okay, so rule number 1, it's absolutely non-negotiable. Do your homework.
Sounds simple, but what does that actually mean for an investor?
Well, for a serious investor, homework starts with mastering the language of business. You just have to be able to read and interpret the 3 core financial statements.
Right, the balance sheet, income statement, and cash flow statement. They can seem intimidating.
They can, but think of them like different medical tests. An X-ray, a blood test, an MRI. Each gives you a critical but different view of the company's health.
Okay, let's maybe quickly define them before we dive into the most important one. First up, the balance sheet.
Right. The balance sheet is like the company's credit report at a specific moment in time, a snapshot.
Assets on one side, liabilities, and equity on the other. Assets, liabilities plus equity. That's the basic equation.
Correct. And for a value investor, a really critical line item to watch here is retained earnings.
Why retained earnings specifically?
Because it's a cumulative account. It tracks all the profit the company has generated over its entire life, minus whatever it's paid out as dividends or used for stock buybacks.
So it's like the company's long-term track record of making money and reinvesting it wisely.
Precisely. Consistently growing retained earnings. That tells you management has likely been a good steward of shareholder capital for years, maybe decades. It's a sign of long-term health.
Okay, got it. Next, the income statement. This is the one most people probably see headlines about.
Yeah, this shows the accounting profit or loss over a period, usually a quarter or a year. Revenues minus expenses equals net income.
This is where we get that famous earnings per share or EPS number.
That's the one. Now, finally, we get to what Dorsey calls the statement of cash flows. And honestly, we see this as the real touchstone for figuring out corporate value creation.
The touchstone. Why? If the income statement tells me the profit, isn't that enough? Isn't net income the bottom line?
That's where a lot of investors, especially newer ones, can trip up. Net income is based on accrual accounting.
Explain that a bit. Accrual accounting.
Okay, so accrual accounting tries to match revenues and expenses to the period they occurred in, not necessarily when the cash changed hands. It's useful for smoothing things out, but it can distort the true picture of money flow.
Meaning, accounting profits can be, let's say, managed, or even manipulated.
Managed is a good word. Obscured sometimes. Whereas actual cash, money in and money out, that's much, much harder to fiddle with. Cash is fact. Profit is an opinion, as the saying goes.
Okay, so what creates this difference? Why can net income look good while cash flow is weak, or vice versa?
Two main culprits, usually. First, you have non-cash charges. The biggest one is depreciation.
Right, accounting for the wear and tear on assets over time.
Exactly. Let's use Dorsey's hot dog stand example. Mike sells a hot dog. His income statement might subtract, say, $1 for depreciation on his cart and tongs. It reduces his reported profit.
But he didn't actually spend that dollar today. It's still in his cash register or his bank account.
Precisely. It's an accounting entry, not a cash outflow. The second big one, and often more dangerous, is accounts receivable.
That's money owed to the company by customers,
Okay.
right? Sales made on credit.
Yes. If Mike sells $7 worth of hot dogs to a corporate client on credit, his income statement immediately books $7 in revenue and profit. Looks good.
But he hasn't actually received the cash yet.
Not a penny. His cash account is unchanged. So his net income might go up by $7, but his cash flow hasn't improved at all from that sale. Not yet.
So putting it together with a hot dog stand, Mike might report, say, $19 of net income for the day. But the actual cash that came in could be different. Maybe it was $23 in cash sales minus that $7 sale on credit he hasn't collected, plus the $1 depreciation charge he didn't actually pay out.
You got it. So his operating cash flow for the day might only be, what, $17? Even though his accounting profit was $19, the cash flow statement reconciles that difference.
Okay, that makes sense. Operating cash flow. But you said savvy investors look for something else, free cash flow.
Yes, and this distinction is absolutely vital. We aren't just interested in operating cash flow, OCF. We're laser focused on free cash flow, FCF.
What's the difference? Why the extra step?
Free cash flow is the cash flow that's left over after the company has paid all its operating bills. A&D made the necessary investments in property, plant, and equipment, what we call capital expenditures or CapEx, just to maintain the business.
So like replacing worn-out machines, keeping the factories running.
Exactly. Think of a mining company. They might generate huge OCF from selling ore. Great. But if they have to immediately spend half of that cash just replacing gigantic, expensive trucks that wear out quickly,
then the cash that's actually free for other things is much lower.
much lower. Free cash flow is operating cash flow minus that maintenance CapEx. It's the cash that management truly has discretion over. It's free to use for paying dividends, buying back stock, making acquisitions, or investing in new growth projects.
So if a company reports rising earnings, but its free cash flow is flat or declining, that's a red flag.
Huge red flag. It suggests the reported profits might not be sustainable, or they're being immediately consumed just to keep the lights on. FCF doesn't lie. It's the ultimate acid test of whether a business is genuinely creating value for its owners. And crucially, it's the FCF figure we'll use when we talk about valuation in Rule 3.
Okay, so Rule 1 is about understanding the language and finding a financially healthy business, focusing on that free cash flow. Now, Rule 2 tells us what kind of healthy business we should be looking for. We need one with an economic moat.
Right, think about it. Success breeds competition. It just does. As surely as night follows day. If you open a wildly profitable coffee shop on a corner,
Someone else will open one across the street pretty quickly.
exactly. An economic moat is that special something, that durable competitive advantage that allows a company to fend off those competitors and earn consistently high profits over a long period.
And Dorsey is specific about long period, right? Not just a good year or two.
Yeah, he suggests a minimum of 5 years, but ideally you're looking for advantages that can last 10, 20 years or more. It's about sustainable, above-average returns on capital.
So the key isn't just high profits today, but the confidence that those high profits will persist. It's like a protective barrier.
That's the perfect analogy, a barrier. Dorsey identifies 4 main sources or pillars for these economic moats.
Let's break them down. What's the first one?
First up is intangible assets. This often comes down to things like patents, licenses, or most commonly, brand power.
Brand power. Okay, but lots of companies have well-known brands. That doesn't automatically mean they have a moat, does it?
No, absolutely not. A recognizable logo isn't enough. A true brand moat exists when the brand allows the company to charge a premium price, leading to excess profits because of that brand recognition and trust.
Can you give an example?
The classic one Dorsey uses is Tiffany. A diamond is essentially a commodity. You can buy a similar quality stone from many places,
Right.
yet people willingly pay a significant premium just to get it in that iconic little blue box. There's an emotional connection, a perceived quality guarantee that lets Tiffany command higher prices and margins than a generic jeweler. That's a brand moat.
Okay, so contrast that with a company like, say, Sony or Ford, big brands, but
Exactly. Hugely well-known global brands. But they operate in fiercely competitive industries, electronics, cars, where consumers are very sensitive to features and price.
so Sony can't really charge way more for a TV just because it says Sony on it?
Not consistently, no. They might have temporary product advantages, but the brand itself doesn't allow for sustained premium pricing across the board. They struggle to generate really high returns on capital consistently because their goods are easily compared and substituted. Their brands are valuable assets, sure, but they don't form a strong economic moat in the way Tiffany's does.
And moats aren't permanent either, right? Brand can fade.
Absolutely crucial point. Think about Kodak. For decades, they had an unbelievable brand moat in photography. A Kodak moment.
Dominated the industry.
Completely. But they famously fumbled the transition to digital photography. Their moat, built on film, just evaporated as technology shifted. Even the strongest moats need constant monitoring.
Okay, so intangible assets is the first source. What's the second?
The second is a cost advantage. This is pretty straightforward. The company can produce its goods or services cheaper than its rivals.
How does that happen? Lower costs.
Usually two main ways. First, through a superior process. Dorsey used to cite Dell's build-to-order model for PCs back in its heyday.
Right. They didn't build computers until someone ordered one.
Exactly. That process meant they avoided holding lots of inventory that could quickly lose value as component prices dropped. Competitors who pre-built machines faced that inventory risk. Dell's process gave them a cost edge.
And the second way to get a cost advantage.
Sheer scale. Being bigger often means you can buy raw materials cheaper, spread fixed costs over more units, run more efficient logistics. Think about Walmart or Amazon in retail.
Or Vanguard in asset management.
Vanguard is a fantastic example. Their unique mutual structure, combined with massive scale, allows them to offer investment products at significantly lower fees than almost any competitor. It's an inherent structural cost advantage that's incredibly hard for others to replicate. That scale is their moat.
Okay, intangibles, cost advantage. What's number 3?
Number 3 is customer switching costs. This is all about inertia. It's the hassle, the time, the expense, or the risk involved for a customer to ditch one product or service provider for another.
So if it's really painful or costly to switch, customers tend to stick with what they've got, even if a competitor offers something slightly better or cheaper.
Precisely. High switching costs lock customers in and protect the incumbent's market share and pricing power.
Where do we see this most strongly?
It's huge in specialized B2B software, for example. Think about enterprise resource planning systems, like SAP or Oracle, in large corporations. Ripping those out and replacing them is a massive, risky, multi-year undertaking.
Yeah, I can imagine.
Dorsey also highlights medical devices. Think about artificial joints from companies like Stryker or Zimmer. Surgeons get trained on the specific tools and techniques for implanting that brand of joint.
So switching to a competitor's joint isn't just buying a different product.
It means the surgeon has to potentially go through time-consuming retraining, learn a new system, maybe even buy new proprietary tools. The hassle factor is immense.
So unless the competing product offers a huge benefit or is dramatically cheaper, the surgeon likely sticks with what they know.
Exactly. The benefits of switching have to be very, very large to overcome that built-in friction. That's a powerful moat.
Makes sense. Okay, that leaves the fourth source.
The fourth source is a bit of a combined category: regulatory advantages and network effects.
Regulatory, like patents or licenses?
Yes, patents are the classic example. A pharmaceutical company like Pfizer gets a patent on a blockbuster drug. For the life of that patent, they have a government-granted monopoly.
Allowing them to charge high prices and earn massive profits.
Right. Until the patent expires, competition is legally blocked. Licenses work similarly in some industries, like utilities or telecom spectrum.
And network effects, that sounds different.
It is. A network effect exists when a product or service becomes more valuable to each user as more people use it. It creates a self-reinforcing cycle.
Like social media. The more friends are on a platform, the more useful it is to you.
That's a modern example. The classic examples are credit card networks like Visa and MasterCard. Every new cardholder makes the network more attractive to merchants. Every new merchant accepting the card makes it more valuable to cardholders.
It feeds on itself, making it incredibly hard for a new network to break in.
Almost impossible without massive investment or a completely disruptive innovation. Marketplaces like eBay or operating systems like Windows also benefit hugely from network effects. The dominant player gets locked in.
Okay, so those are the four qualitative sources of moats. But how do we actually see if a moat exists and is working? We need to look at the numbers, right? Back to rule one.
Absolutely. The qualitative story is essential, but it must be validated by the quantitative evidence in the financial statements. We need to see proof of superior, sustained profitability.
What specific metrics should we focus on?
We look for consistently high returns on capital, specifically return on assets, ROA, and return on equity, ROE, and of course, strong and consistent free cash flow generation.
Dorsey mentions a benchmark for ROE.
Yeah, for non-financial companies, he suggests looking for a consistent ROE above 15% as a potential indicator of a moat. But, and this is a really important but, you have to be careful how that ROE is being generated.
Meaning, what's the trap?
The trap is leverage, or debt. A company can artificially boost its ROE simply by taking on a lot of debt. More debt means less equity in the denominator of the ROE calculation, net income equity, which pushes the ratio higher.
So a high ROE might not reflect superior business performance. It could just reflect risky borrowing.
Precisely. If a company hits 18% ROE but it has a dangerously high debt-to-equity ratio, that's not a sign of a moat, it's a sign of financial risk. You've essentially just borrowed your way to a higher return number.
So what's the confirmation? How do we know the high ROE is real?
You need to see that high ROE, accompanied by healthy profit margins, strong free cash flow, and ideally a high return on invested capital, ROIC, which includes debt in its calculation. And all of this without excessive leverage on the balance sheet. The numbers, viewed together, must confirm the qualitative story of a durable competitive advantage.
Okay, so we've done our homework. Rule one, found a great business with a durable moat. Rule two, we're halfway there, right?
Only halfway. Because even the best company on earth can be a terrible investment if you pay too much for it. That brings us to the crucial discipline of rule number 3. Have a margin of safety.
Finding the great company is one thing. Figuring out what it's worth is the other half. And paying too high a price, that guarantees disappointment.
It almost guarantees it.
Yeah.
Even if the business performs exactly as you hoped, if you paid a price that already reflected perfection or even better than perfection growth, your returns will likely be mediocre or worse.
So the margin of safety is what exactly?
It's your buffer, your insurance policy against being wrong or against unforeseen negative events. It's the difference between the current market price of the stock and your own conservative estimate of the company's underlying or intrinsic value.
Like buying insurance. You build in a cushion because, as Dorsey says, the future has a nasty way of turning out worse than expected.
Exactly. Think about buying a used car. You might estimate it's worth $15,000 based on its condition and mileage, but would you pay exactly $15,000?
Probably not. I'd want a bit of a deal, maybe offer $13,000 or $14,000 just in case my estimate is off or something breaks next week.
That $1,000 or $2,000 difference, that's your margin of safety. It protects you if your value assessment was too optimistic or if unexpected problems arise. It's the same principle with stocks.
Did you give a stock example?
Sure. Think about Coca-Cola back in the late 1990s during the tech bubble. Coke undeniably had, and still has, a massive economic moat. Incredible brand, global distribution.
Right. A quintessential blue chip.
But the stock price got bid up to something like 40 or 50 times earnings. Insane levels. Investors who paid that price, even though it was a great company, saw basically zero returns for years, maybe even a decade.
Because the price already reflected decades of future growth that was almost mathematically impossible to achieve.
Precisely. Even if you conservatively estimated Coke's intrinsic value was, say, 30 times earnings back then, which is still high, applying a margin of safety would mean you'd only consider buying it if it dropped to maybe 20 or 25 times earnings. That discipline protects your downside.
Okay, but this hinges on estimating that intrinsic value. The market price is easy to see. It's right there on the screen. How does a value investor actually calculate intrinsic value?
This is where the real analytical work comes in. The most rigorous method, and the one Dorsey advocates, is estimating the company's future discounted free cash flows, or DCF analysis.
DCF. Okay, sounds complex. Why this method?
Because it forces you to think like a business owner, not a stock trader. It strips away the market noise and asks the fundamental question. If I could buy this entire company today, What is the present value of all the cash it's likely to generate for me from now until forever? It focuses purely on the economic engine of the business.
Let's try to break down DCF simply. It involves predicting future cash flows and then discounting them back.
That's the core idea. You project the company's free cash flow, remember FCF from Rule 1, out for a certain period, maybe 5 or 10 years. Then you have to make two key subjective assumptions.
Okay, what are they?
First, the growth rate of those free cash flows. How fast do you realistically expect the company to grow its FCF over your forecast period? Second, the discount rate.
The discount rate, what does that represent?
The discount rate is essentially your required rate of return, adjusted for the riskiness of those cash flow projections. $1 of cash flow expected 10 years from now is worth less than $1 today because of inflation and risk. The discount rate quantifies that difference.
So a very stable, predictable company like
Right.
maybe a utility or a consumer staple would get a lower discount rate.
Generally, yes, because you have higher confidence in forecasting its cash flows. A more volatile tech company or a cyclical industrial firm would warrant a higher discount rate to compensate for the greater uncertainty. Let's say you use 9% for a stable company.
Okay, so project FCF, choose a growth rate, choose a discount rate. Then what?
Then you calculate the present value of each year's projected FCF using that discount rate. But you can't just start after 10 years. The business hopefully keeps going, so you need to estimate a terminal value.
Terminal value, what's that?
It represents the value of all the cash flow the company is expected to generate beyond your explicit forecast period, say, from year 11 into perpetuity, assuming a stable, lower long-term growth rate. It's often a very large part of the total DCF value.
So you sum up the present value of the 10 years of projected FCF, add the present value of that terminal value, and that gives you the estimated intrinsic value of the entire company.
Of the operating business, yes. You might need to make adjustments for cash and debt to get to the equity value per share. Let's say, using the Clorox example assumptions from the source, maybe 5% FCF growth, 9% discount rate, you arrive at an intrinsic value of $54.30 per share.
Right. That's the number we compare to the market price, and the final step is applying the margin of safety to that $54.30.
Exactly. Now, the question is, how much of a discount should you demand below that $54.30?
And that depends on the risk, right?
Absolutely. It's not one size fits all. For a very predictable wide moat company like, say, an Anheuser-Busch, maybe a 10% or 15% margin of safety is enough. If you value it at $100, you might buy it at $85 or $90.
But for a riskier company, no moat, volatile industry.
For those, you need a much bigger cushion, maybe 30%, 40%, even 50% below your estimate of intrinsic value. If you think a speculative stock might be worth $20, you probably shouldn't touch it unless it's trading at $10 or $12. That discipline of demanding a discount is your primary defense against losing money.
This focus on valuation and downside protection flows perfectly into rule number 4. Hold for the long haul.
It really does. Because if you've done your homework, found a moated business, and bought it with a margin of safety, the best course of action is usually to do nothing. Let the company compound value over time. Frequent trading is, as Dorsey puts it, fundamentally a loser's game.
Why a loser's game? If you're smart, can't you jump in and out?
Dorsey argues you should treat buying a stock like buying a significant asset, like you're buying part of the actual business, not just a ticker symbol. You wouldn't buy a rental property and then sell it 6 months later, then buy another one. The transaction costs would kill you.
And those costs exist in stock trading too. What are the big ones?
The two great thieves of investment returns, especially for active traders, are commissions and, much more significantly, taxes. These create a huge, often underestimated hurdle.
The source material has a really striking comparison to illustrate this. Long-term Lucy versus Trader Tim.
Yeah, it's a powerful illustration. Let's walk through it. Both Lucy and Tim start with $10,000. Both are pretty good investors, achieving the same gross annual return of 10% per year over 30 years.
Same starting point, same skill in picking investments, but their approach is different.
Totally different. Long-term, Lucy buys her portfolio and holds it for the entire 30 years. She only pays taxes at the very end, and because she held for over a year, she pays the lower long-term capital gains rate, let's say 15%.
Okay, now Trader Tim. He also gets 10% a year gross, but he's constantly trading, maybe turning over his portfolio every 6 months.
Right, which means every 6 months he realizes his gains and has to pay taxes on them. And because he held for less than a year, he pays the much higher short-term normal gains rate, let's say 35% in this example.
So every 6 months, a chunk of Tim's profits gets skimmed off by taxes, reducing the capital he has left to compound. Lucy's capital keeps growing tax-deferred.
Exactly. And the difference over 30 years is just staggering. After 30 years, long-term Lucy, paying taxes only once at the end, ends up with around $244,000.
Okay, $244,000 from a $10,000 start? Pretty good. What about Trader Tim?
Trader Tim, despite generating the exact same 10% annual return before taxes, ends up with only about $114,000.
Wow, less than half. Just because he traded frequently and paid higher taxes along the way.
Less than half. And remember, that example doesn't even include brokerage commissions Tim would have paid on all those trades. The drag is enormous.
So the takeaway is, the cost of impatience is huge.
Immense. The math shows that for Trader Tim to end up with the same $244,000 as Lucy, he would need to generate a pre-tax return that's roughly 5 percentage points higher every single year. So 15% instead of 10% just to overcome the drag of taxes and costs.
That's an incredibly high bar to clear consistently.
Almost impossibly high for most people over decades. Patience, fueled by buying right and holding on, truly does yield a lavish reward through the power of compounding, especially tax-deferred compounding.
All right, that powerful example of Lucy and Tim sets us up perfectly for the final rule, rule number 5. Know when to sell. And just like the buying decision, it sounds like this isn't about timing the market's ups and downs.
Absolutely not. That's the critical starting point. Dorsey is adamant. You do not sell stock simply because its price has gone down or even because it's gone up a lot. Short-term price movements are mostly noise.
Why noise? Doesn't a falling price mean something's wrong? Or a rising price mean it's time to take profits?
Not necessarily. Prices move for countless reasons unrelated to the underlying business fundamentals. Algorithmic trading, sector rotations, index rebalancing, general market panic, or euphoria.
Yeah.
None of that tells you anything useful about whether your company's moat is intact or its intrinsic value has changed.
So you need to focus on the business, not the stock price ticker.
Exactly. Monitor the health of the companies you own, not the daily volatility of the pieces of paper representing them. So, if price isn't the trigger, what are the legitimate reasons to sell a stock, according to Dorsey? He lays out a clear checklist.
Okay, let's go through that checklist. What's the first trigger?
First, ask yourself, did I make a mistake in my initial analysis? Be honest. Maybe you overestimated the strength of the moat, underestimated the competition, or misjudged management's ability to execute their plan.
So if new information comes to light that invalidates your original investment thesis,
then it's usually best to admit the error, cut your losses, or take smaller gains and move on. Don't let pride keep you in a position where the original reasons for buying no longer hold true.
okay, makes sense. What's the second selling trigger?
Second, have the fundamentals of the business genuinely deteriorated. This is about the moat shrinking or the long-term prospects dimming. Is new competition successfully stealing market share and eroding profit margins? Is the industry facing a permanent structural decline? Is management making poor capital allocation decisions?
So if the underlying quality or earning power of the business is significantly worse than when you bought it,
then its intrinsic value has likely decreased. Even if the stock price hasn't fallen yet, the reason for owning it might be gone. It could be time to sell before the market fully recognizes the deterioration.
right. Trigger 3.
Third, has the stock price risen so far above your estimate of intrinsic value that it's now significantly overvalued? Sometimes the market gets overly enthusiastic about a company, even a great one.
Like the Coke example earlier.
Exactly. The market might offer you a price that represents an egregious premium to any reasonable calculation of the company's worth. Dorsey calls this taking advantage of other investors' optimism.
So even if the business is fine, if the price just gets way ahead of itself, you sell.
You should strongly consider it. If your conservative estimate of intrinsic value is $100 and the market is suddenly willing to pay you $180 for it, that might be too good an offer to refuse. You can potentially redeploy that capital into something more reasonably priced.
Which leads perfectly into the fourth and final trigger.
Right. Fourth, is there something clearly better you can do with the money? This is about opportunity cost and efficient capital allocation.
Meaning, even if your current holding is okay, maybe fairly valued, if you find a new opportunity that looks significantly undervalued and offers a much higher potential risk-adjusted return,
then it might make sense to sell the good holding to fund the purchase of the potentially great one. As an investor, you should always be striving to allocate your capital to the assets you believe offer the best future returns relative to their risk.
So it's a disciplined, business-focused process. Mistakes, deterioration, overvaluation, or better opportunities elsewhere, not market timing.
Precisely. Now, alongside these rules, Dorsey emphasizes that avoiding stupid mistakes is often more important for long-term success than making brilliant stock picks. He outlines 7 common behavioral traps that consistently sabotage investors.
These sound crucial. Let's dedicate some real time to these traps. What's the first one? Sounds dramatic. Swinging for the fences.
Yeah, this is the temptation to load up on highly speculative, risky stocks, hoping for that one huge winner, that 10-bagger that will make you rich quick. Often these are small, unproven growth companies.
The next Microsoft dream.
Exactly. But the math works heavily against you. First, finding the actual next Microsoft when it's tiny is incredibly difficult, bordering on pure luck. Second, the consequences of being wrong are severe. A stock that drops 50% needs to double 100% gain just to get you back to even.
And Dorsey points out that historically, small cap growth stocks as a category have actually been the worst performing segment of the equity market.
Statistically, yes. The failure rate is incredibly high. Discipline means aiming for consistent, repeatable base hits and doubles. Solid companies bought at fair prices, not constantly trying to hit highly risky home runs where you're more likely to strike out completely and suffer permanent capital loss.
Okay, trap number 2 sounds familiar. Believing it's different this time.
The 4 most expensive words in investing. This is the tendency to ignore historical patterns and valuation metrics, especially during market bubbles, convincing yourself that old rules no longer apply because of some new paradigm.
We saw that with the Nifty 50 stocks in the 70s.
Yeah.
And definitely during the dot-com bubble in the late 90s.
Absolutely. Investors persuaded themselves that internet companies deserved infinite valuations, even if they had no profits or even revenues, because the internet was going to change everything.
Which it did eventually, but not in a way that justified those stock prices at the time.
Not even close. When the bubble inevitably burst, the losses were catastrophic for those who bought near the cot, paying insane multiples based purely on hype and ignoring centuries of valuation history. History doesn't repeat exactly, but it often rhymes, especially when it comes to human psychology and speculative excess.
Closely related is mistake number 3, falling prey to fear and panic, especially when the market is down.
This is probably the single biggest destroyer of wealth for individual investors. Seeing your portfolio drop significantly triggers a primal fear response, leading people to sell perfectly good businesses at the absolute worst time when they're on sale.
Selling low out of fear after having bought high during optimism. The exact opposite of what you should do.
Exactly. It takes real emotional fortitude, real courage to go against the herd and buy when everyone else is panicking. But that's precisely when the best opportunities often arise. As Warren Buffett famously said, be fearful when others are greedy, and greedy only when others are fearful. Those who buy quality companies during downturns are the ones who reap the rewards in the recovery.
Okay, number 4 is the siren song for many. Trying to time the market.
This is the belief that you can successfully jump in and out of the market, catching the rallies and avoiding the declines. Financial media often encourages this.
But Dorsey says it's impossible.
Statistically, consistently timing the market correctly is virtually impossible over the long term. Study after study confirms this. Why? Because market returns are incredibly concentrated.
Concentrated. What does that mean?
It means that the vast majority of a decade's stock market gains often occur on just a handful of incredibly strong days. If you're out of the market trying to time it and you miss just those few best days, your long-term returns get absolutely crushed.
So the risk of being out of the market and missing the upside is actually greater than the risk of being in the market during a temporary downturn.
For a long-term investor, absolutely. Dorsey notes that Morningstar tracked thousands of mutual funds over decades, and not a single one demonstrated a consistent ability to successfully time the market. It's a fool's errand. Stay invested.
Mistake number 5 brings us back to rule 3, ignoring valuation.
Right. This is buying a stock simply because you like the story or because the price momentum looks strong, without any regard for whether the current price makes sense relative to the company's actual earnings power or intrinsic value.
Just chasing performance or following the crowd.
Yes, but price is what you pay, value is what you get. If you pay a high price, your future returns are inherently lower and your risk is higher. Conversely, buying when expectations and valuations are low provides a margin of safety. Paying attention to price is perhaps the single best way to mitigate investment risk.
Okay, 2 mistakes left. Number 6 loops back to rule 1 again, relying on earnings for the whole story.
We spent a lot of time on this earlier, highlighting the difference between accounting earnings, net income, and actual free cash flow. This mistake is believing that reported EPS is the only thing that matters.
But as we discussed, accounting earnings can be manipulated or distorted by accruals and non-cash charges.
Exactly. A company can report rising earnings per share through aggressive accounting or by taking on debt for share buybacks, even while its underlying cash generation is stagnating or declining.
So you need to look beyond the headlines.
You absolutely must dig into the statement of cash flows. If the operating cash flow and, more importantly, the free cash flow aren't confirming the earnings growth story, be very skeptical. Cash flow is king because it reflects the real economic reality of the business. If the cash isn't there, the reported value probably isn't either.
And the final mistake, number 7.
Number 7 is related to Rule 5 on selling, trading too much. This echoes the Lucy versus Tim example. Constantly buying and selling incurs those transaction costs and, more importantly, triggers taxes that erode your long-term compounding. Patience is not just a virtue in investing. It's a mathematical necessity for optimal results. Hashtag tag outro.
Wow, okay. This has been a really comprehensive deep dive into Pat Dorsey's framework. It feels like we've covered a lot of ground, from analysis to behavior.
We have, and it really boils down to a disciplined, repeatable process.
Let's quickly recap those 5 rules one last time. Rule 1, do your homework, understand the financials, and focus like a laser on free cash flow.
Rule 2, find economic moats. Look for businesses with durable competitive advantages that protect profitability. Intangibles, costs, switching costs, network effects.
Rule 3, have a margin of safety. Always buy at a meaningful discount to your conservative estimate of intrinsic value. That's your protection.
Rule 4, hold for the long haul. Avoid frequent trading. Let the power of compounding and tax deferral work its magic over years, even decades.
And Rule 5, know when to sell. Base your selling decisions only on fundamental changes to the business or its valuation, or finding better opportunities, never on short-term market noise.
Follow those rules and diligently avoid those 7 common behavioral mistakes we just discussed, and you're putting the odds significantly in your favor for long-term investment success.
It really emphasizes discipline and patience over trying to predict the unpredictable.
That's the core message. But I want to leave you, the listener, with maybe one final provocative thought. It's something that ties all these rules together and adds another layer of analytical rigor.
Okay, I'm intrigued. What is it?
Before you invest a single dollar in any stock, no matter how excited you are about it, you must force yourself to construct a detailed, convincing bear case for that investment.
A bear case. So actively try to argue against buying the stock. That sounds counterintuitive. Why focus on the negative?
Because it's the ultimate test of intellectual honesty and the robustness of your bullish thesis. It's far too easy to fall in love with a company's story, its growth prospects, its charismatic CEO. We get confirmation bias.
We look for evidence that supports our initial excitement.
Exactly. Constructing a bear case forces you to actively seek out the potential flaws, the risks, the things that could go wrong, what could disrupt the moat. How strong is the competition, really? What if management stumbles? What if the economy turns down?
Dorsey mentions a personal mistake related to this, right?
Yeah.
A company called Ballantine of Omaha.
Yes, a painful but valuable lesson from early in his career. Ballantine made movie projection equipment in the mid-1990s. It seemed like a good niche business, maybe even with a small moat.
Okay, sounds reasonable so far. What went wrong?
What went wrong was a failure to properly analyze the customers. Ballantine's main customers were the big movie theater chains. And in the mid-90s, those chains were undergoing a massive, debt-fueled expansion spree, building multiplexes everywhere.
So Ballantine sales looked great because its customers were booming, but that boom was built on shaky foundations.
Precisely. The theater chains were highly leveraged, the expansion was unsustainable. When that building boom inevitably cooled off, and some chains hit financial trouble or even went bankrupt.
Ballantine's primary customer base suddenly dried up almost overnight.
Exactly. The stock crashed. The profound lesson was, if he had rigorously built a bear case beforehand, he would have been forced to ask critical questions like, what is the financial health of our key customers? And what happens to our sales if this multiplex building frenzy slows down or if their access to debt tightens?
So thinking through the potential negatives forces you to identify those hidden risks or dependencies.
It does. It helps you spot potential roadblocks you might otherwise overlook in your enthusiasm. And maybe just as importantly, if you do investigate the bear case thoroughly and conclude that the risks are manageable or already reflected in the price,
Then you have much stronger conviction to actually hold onto the stock during inevitable rough patches or market downturns.
Exactly. Because you've already considered the negatives, you know what the real risks are, and you can assess whether temporary bad news actually impacts your long-term thesis or if it's just short-term noise. It gives you the confidence to stick to your plan when others might panic.
That's really powerful advice. It's about stress testing your own ideas before committing capital. Investing success isn't just about picking winners. It's about having the discipline, the analytical framework, and the behavioral temperament to avoid those common, often self-inflicted losses.
Well said. It really comes down to being a rational business analyst first and a stock market participant second. Focus on the business, control your emotions, and think long-term.